All right, so we're going to hear one more stock pitch, then we'll give everybody a 5-minute break. So we are going to move on now to a combo thesis about changing our sector weight in the information technology sector. So the first pitch we'll hear is to reduce our exposure to the Microsoft and Intel positions. Our first presenter will be Ashley Breckheisen, who is originally from Linden, Kansas, currently lives and works in Lawrence. Ashley has a 5-year-old daughter, Isabella, who she calls the source of her drive and inspiration. Ashley is scheduled to graduate with a BBA in finance this week. She plans to begin studying for her CFA charter and hopes to soon be employed in the financial services sector. Ashley's quote about the course is that APM has taught her many things, but professionalism, critical thinking, and rigorous financial analysis are the most resounding. Also presenting on this team is Stevie Schultz, who is from Neodesha, Kansas. Stevie, you may have seen competing on the boards on the Washburn's women's basketball team for a number of years. Stevie graduated with an undergrad degree in accounting in May 2012 and is completing her MBA this semester. Stevie will begin studying for the CPA exam this summer, and she begins with McGladrey in Kansas City this fall as an assurance associate. And I'd also just like to add a comment. It's always the way in the world that the person sometimes who does some of the most work gives you the shortest bio, but Stevie's fingerprints are all over position reviews. She has switched teams so many times this semester. I think she knows a little bit about everybody's research and has really been a workhorse for us in portfolio management. So let's welcome our next presenters.
So I'm Stevie Schultz.
And I'm Ashley Breckheisen, and we'll be proposing a trim recommendation on our Wintel stocks.
Just to keep things clear while we're presenting, the majority of the time that I'm talking, I'll be talking about Intel, and then the majority of the time that she's speaking, it'll be about Microsoft. So to start, Intel Corporation overview. Intel designs, manufactures, sells integrated digital technology platforms worldwide. They're mostly known for their microprocessors. They're in the semiconductor industry. They're founded in 1968 and based in California.
Microsoft was founded in 1975 and is headquartered in Redmond, Washington. They're in the system software industry. They develop, license, and support software products and services, and they design and sell hardware worldwide.
To start, we have Intel's revenues by geographic segments and business segments. To start, on the right is geographic segments, and we can see that their revenues are pretty evenly proportioned among segments. And on the left is business segments. We can see the majority, 64.3% of their revenues coming from that PC client group, and Intel relies pretty heavily on that group.
Likewise, we have a breakdown of Microsoft's revenues by business segment and geographic region. As you can see, Microsoft's Business Services Division accounts for the largest amount of Microsoft's revenue at 32.4%, followed by the Windows Division and Servers and Tool Division, each of which are bringing in about 25% of Microsoft's revenues. The second chart shows that 52% of these revenues come from within the United States, and the remaining 47.3% from other countries around the world.
Now we'll look into the historical performance analysis. This is the 3-year CAGR for Intel on top and Microsoft on the bottom. The majority of the growth rates are positive and healthy, with the exception of the free cash flow for Intel, which is negative. We'll get deeper into this later, but it's important to note that both have positive EVAs and at the same time negative MVAs. Here we have Intel against the S&P. Intel's been behind the S&P since June of 2012. In the past month, there's been a small price increase, and that is one factor to support our trim thesis.
Following on that is Microsoft stock benchmarked against the S&P. As you can see, Microsoft diverged from the S&P about the same time Intel did in June of 2012. Although it hasn't experienced the same dire decrease that Intel does, it does perform very similarly. And also note that in April 13, it experienced the same increase that Intel did as well.
This is Intel and Microsoft compared to a competitor, Qualcomm. and it's important to note that both Intel and Microsoft lag behind Qualcomm. This is a comparison of Qualcomm and Intel's margins and yields. The past 5 years, so since 2008, operating margin for Intel has increased while Qualcomm's has decreased. Free cash flow margin is the opposite. Intel has decreased while Qualcomm has increased. Overall, Qualcomm's margins are higher than Intel's, which indicates that Qualcomm's a little more efficient than Intel. But Intel has higher yields, which also supports our trim thesis, because that will keep the portfolio yield up.
Likewise, we have Microsoft Corporation versus Qualcomm on their margins and yields. As you can see, Microsoft has had much more effective margins and yields consistently over the last 4 years over Qualcomm, and continues with the trend of keeping our yields up, as Stevie just mentioned.
Now we'll dive into a little bit deeper, just specifically to Intel. We have total revenue and net income. Since 2009, there's been an increasing trend. There's a small contraction in 2012 that was due to low PC sales. Here we have gross profit margin and operating profit margin. Since 2010, there's been a decreasing trend. We would like to see these margins increasing, which is one reason that we've decided to trim the position. Total debt to assets and long-term debt to equity. From 2007 to 2010, they kept those under 5%, but in 11 and 12, they've increased quite significantly. And again, this is the low PC sales being reflected in the financial measures. Net profit margin and free cash flow margin have been on a negative trend since 2010. And that's one reason we're deciding to trim. We'd rather have those growing. Again, with ROIC, for our portfolio, we'd rather have the ROIC growing, and that supports our trim thesis. NOPAT and free cash flow. Free cash flow has been decreasing. NOPAT, you can see that contraction in 2012 again as a result of the low PC sales. Here we have EVA and MVA. Since 2010, the trend of MVA has been lower than the trend in EVA. And this indicates unpriced economic profit that may provide the stock price with a boost in the future that we can benefit from.
Moving into Microsoft's historical performance analysis. First, with revenue and net income. Like Intel, both total revenue and net income show a generally increasing trend, with the exception of 2009. This is obviously attributed to the recession. It is worth noting that 2012 is the first year that Microsoft fails to convert total revenue into net income. Next, of course, is earnings per shares and dividends per shares. Earnings per share, though it has fluctuated, has hovered around the $1.95 average over the last 6 years. But despite these fluctuations in EPS, notice how Microsoft maintains a consistent growth in its dividends per shares. Looking at gross profit margin and operating margin, we notice that both the operating profit margin and gross profit margin are extremely stable over time and exhibit very little movement during the time of the recession. And as we touched on before, both of those margins exceed those of Intel and Qualcomm. Here's Microsoft's return on assets, equity, and invested capital. ROA and ROE have been fairly consistent with the exception of 2012. But most importantly, note that Microsoft's extremely attractive ROIC, which has been maintaining an 80% average over the last 6 years. And last is Microsoft's economic value added and market value added. Microsoft's market value added has been on a decreasing trend in the recent past, but notice how Microsoft's EVA has been trending upward over the same period. This suggests that there's a lot of unpriced EVA that should bolster Microsoft's price when the price correction does occur in the market.
Now we'll move on to Porter's 5 forces for Intel. First thing is supplier power that we've rated at low. This is because suppliers have materials that are abundant. The basic material that's used to make semiconductors, which is silicon, is abundant in nature. And then there are several suppliers, so because of this, they have low pricing power and switching costs are low. Buyer power, we rated at moderate. There's buyer diversity. Some of Intel's buyers are companies like HP, Dell, and Samsung. And this buyer diversity is good for Intel because it gives Intel the pricing power. And then we have buyer backward integration. Several of Intel's buyers are now making their own processors. An example of that is Samsung and Toshiba. Because of this, the pricing power is given to companies like Samsung and Toshiba that are integrating backward. Competitive rivalries, we've rated at high. The market is shifting. the market is shifting from the PC over to the mobile phone, and it's also shifting in the sense that consumers prefer everything to be on one device. And because of this, non-direct competitors are stealing Intel's market share, and then it also hurts Intel's pricing power. Then we have threat of substitutes that we've rated at moderate. Technology today is reliant on processors, so the threat of substitutes really isn't a threat to Intel's business. There's high switching costs. Because there are a limited number of substitutes, the switching costs are high. And then technology advancements, innovations will always serve as a threat. Then we have threat of new entrants. We rated that at low. In this industry, there's a lot of significant R&D costs, a need for economies of scale, capital, and brand identity. So Intel's competitive position in the semiconductor industry has diminished somewhat, but they are still a significant player.
Next is Microsoft's Porter's Five Forces. Supplier power is high. Microsoft experienced high pressure from its suppliers centered around its proprietary partnerships, ability to mandate prices, and costs associated with acquiring trademarked and copyright products that Microsoft uses in its entertainment devices. The buyer power is moderate. While there is no real threat of buyer backwards innovation, and they do still hold the market in the business systems industry, buyer preference does raise the buyer's ability to set prices. The competitive rivalry is high. Due to the change in buyer preference, Microsoft can no longer price its products with disregard to the competition. Additionally, other companies like Qualcomm and Sony are stealing market share away from Microsoft in the mobile and gaming industries or markets, and poor customer reception to Microsoft's latest products is giving its competitors a strong advantage. Threat of substitutes is moderate. Companies like Google are beginning to offer comprehensive business packages. None of these yet compare to Microsoft's, and the cost of switching to these substitutes would be very high for a business. However, Microsoft's few attempts to enter the mobile market have been met with formidable competitors. A good example of this would be the early 2000s Pocket PC release, which was quickly answered by the BlackBerry. Threat of new entrants is low. Microsoft Business Systems are still the most often used in businesses and schools here in America and in many places worldwide. Designing a new business system or server and tool product as comprehensive as Microsoft's but with a new edge of diversification would be very difficult, and any attempt to do so would also be very program and R&D intensive as well as expensive and time consuming.
Now we have Intel's SWOT. Strengths for Intel: they have a strong brand image, a strong processor market position, they are advanced technologically, and they also have loyal customers. Weaknesses: those declining PC sales that I mentioned. They're not focused on the mobile market, and some have even said the mobile market is the future of the internet. And then they have high retail prices. Opportunities: partnerships and alliances will always be an opportunity. Growing that global semiconductor market, and then, as I mentioned, the mobile market. Threats: there's rapid technology changes, and there's always a threat of innovations, increasing competition, and political issues.
For Microsoft, some of their strengths are their enterprise businesses, their diversified product line, their established brand name, and their successful tools and service division. Weaknesses for this company revolve around program security vulnerability, management's inability to deliver products that roll out on schedule and meet customers' demands, supply chain costs, as mentioned in the supplier power and porters, and failure to time its mobile market entry properly and to enter with quality products. Some opportunities available to Microsoft lie in its enterprise-oriented offerings and its cloud computing. Windows has launched Azure, which is their version of cloud computing. Competitors like Amazon, Google, and Apple have all came at cloud computing with a different perspective. So this leaves room for Microsoft to experience success in the cloud computing market, even though they've entered a little bit late. The main trigger there will make sure that all of its offerings are differentiated and of good quality. Okay, there we go. And lastly, some threats to Microsoft's position include the overall decrease in the PC industry size and the increase in the popularity of mobile devices, piracy problems in emerging markets, as these are diminishing revenues for Microsoft and also contributing to the program security issues that they're experiencing. Google's control on the search engine market. Bing and Yahoo have been able to gain popularity here recently, but none of this popularity is coming from any of Google's popularity being detracted. And also the iOS, Android, and Google platforms that are already well established in the mobile market.
For our forecast for Intel, income statement. To be conservative for revenue growth, we dropped it down to 5.1% in 2013 and tapered it down to 2% perpetuity. For the margins, gross margin and operating margin, we took more of a 7-year average than the 5-year average that's shown. Net margin, to be conservative, we dropped it down to 18.5. Common shares growth seems good to us. And then dividend growth, to be conservative again, we started at 3.5% and tapered to 1% perpetuity. For the balance sheet, we like the averages of 11.6 and 6.8 for the first two, cash equivalents and total receivables. Then inventory, we took the past 4-year average of 8% and kind of kicked out that 2008 percentage since it was so high. And then we liked all of these averages except for debt and equity. For debt, considering the 2012 level of 25.2%, we thought it was unrealistic that 2013 would be at 10.6%, so we raised that up to 20%. For equity, kind of the same thing. We didn't think 103.7 was realistic since it was 96 in 2012, and to be conservative, we wanted to drop that down to 90%. Here's the WACC for Intel. We used the same long-term growth rate of 2% that we did for revenue growth, and we smoothed the beta down to 1, which gave us a WACC of 8.1%. Now, based on the discounted free cash flow model, Intel's undervalued by $12.41. We can see that its intrinsic value is expected to increase. It has been consistently undervalued since 2008, and as we hope to benefit from when the market price hopefully catches up to that intrinsic value. Then the dividend discount model. We had those same growth rates in there that we used in the forecast, and we smoothed the beta to 1. We can see our intrinsic value of $12.18 and our current price of $21.69. And more than half the stock price is supported by the present value of the dividends alone. Here we have the intrinsic value estimates versus the current price. As we've talked about, all the metrics are undervalued except for that dividend discount model, but it does cover half the price.
And now we'll move into forecasting assumptions for Microsoft. Revenue growth was adjusted to Capital IQ analyst expectations and then tapered to a conservative 3% in perpetuity. The margins were adjusted to Capital IQ and Argus suggestions and then tapered to conservative perpetuities. The common shares growth is expected to continue to decline. We chose to keep that negative 1.5% growth into perpetuity because we recognize Microsoft's current number of shares outstanding is extremely high and one of the highest number of shares outstanding in the industry. And then for dividend growth, we also reduced that consistent with the margin of safety principle and tapered that down to 2% in perpetuity. For the balance sheet forecasting assumptions, cash and equivalents were tapered off from 2012 to be conservative. Total receivables average was reduced to offset the high number of receivables in 2018 due to the recession. And inventory was reduced to a conservative rate that was more sustained between 2009 and 2010. Next, the total current assets average was lowered to offset the abnormally high rates in 2011 and 2012. Net PP&E was tapered off in conservation, and total debt and equity were raised to be a better reflection of the last two previous years. Next, looking at Microsoft's weighted average cost of capital. As you can see, we've used the long-term growth rate of 3. We've smoothed up the beta to 1, which is only a small adjustment, and that gives us a weighted average cost of capital of 8.5. If you recall, Microsoft has maintained an average ROIC of around 80%. So this gives us a very attractive ROIC to weighted average cost of capital. Next, moving into valuation. Based on our modeling assumptions, the intrinsic value of free cash flows placed Microsoft as undervalued by $25.39. This results in a 95% undervaluation from the 2012 year-end stock price of $52.10. Also see how per share intrinsic value is expected to increase by more than $10 by 2017. Like Stevie mentioned, we expect to benefit from the year-end stock price catching up with Microsoft's intrinsic value based on the unpriced EVA that we've recognized in the stock earlier. Moving on to the dividend discount model. As you see, the dividend discount model does contradict the intrinsic value slightly. Per the dividend discount model, Microsoft's future dividends only support a stock price of $14.52 per share. However, this is almost half the cost, half of the current price of $30.83 is supported purely by the discounted flow of dividends. So based on this model, Microsoft is overvalued by 112.33%. Due to the conservative forecasting used, Microsoft's dividend yield is expected to decrease from 4.2% to 2.6%. However, it kind of goes without saying that the dividend yield will likely remain a little bit higher than this since we went about it conservatively. This next slide here, of course, is just the intrinsic value versus the current price. First, notice that the dividend discount model is the only valuation model that prices Microsoft as overvalued. And now we see that all the other valuation metrics suggest Microsoft to be undervalued by an average of $55.
Here is one of Intel's charts that we pulled off of stockcharts.com. You can see its current price there at $23.96. You can see it breaking out of its 50-day moving average, and that is another reason that we are choosing only to trim Intel.
Likewise, Microsoft has also experienced a recent increase in April 2013 and has broken out of the 50-day moving average. We feel this shows good movement in stock price and possibly the beginning of some stock price correction and supports our trimming thesis.
Okay, so let's talk about Wintel positioning. The PC versus the mobile. The PC industry year-over-year decline in PC sales. Gartner has it at 11% and IDC has it at 14%. Smartphones are in about 55% of US homes today, as opposed to 36% in 2010. So you can see that's been almost a 20% increase. Consumers are migrating away from the PC toward mobile devices. Now these next few questions that I have I got from a survey done by Accenture, and Accenture is actually one of our positive positions in our portfolio. So the first one, which of these consumer electronics do you plan to purchase in the next 12 months? 41% of these consumers said smartphone, while 36% said PC. So we can see that more consumers are planning to buy the smartphone than the PC. The next one is, of the consumer electronic devices you currently own, please rank the top 5 that you use most often. Now what I have circled there is the difference between 2010 and 2012, and we can see that the PC is up by 2, while the smartphone is up by 30. So there's a lot of growth there with the smartphone, but very minimal growth with the PC. The next one is, which of the following consumer electronics do you currently own? This one goes from 2009 to 2012. A smartphone starts at 26% in 2009 and grows to 58% in 2012. You can actually see all of these devices are growing. The tablet goes from 8 to 25%, but then when we get down to the bottom with the PC, it goes from 91 to 94%. So we can see that demand in mobile devices is increasing, while that PC demand is pretty stagnant. This is from the IDC. It's the year-over-year PC sales. In the first quarter of 2012, you can see it's at a positive 4%, but then by the first quarter of 2013, it's down to a negative 14%. PC sales the year-over-year PC sales have declined the past 4 quarters. And here we have Intel's revenues by business segments. On the left is 2007, and on the right is 2012. So we can see that PC client group that Intel really relies on has changed from 70.8% to 64.3%, but they're not diversifying away from that reliance on that PC-based revenue fast enough, and because of this, future growth potential is questionable.
Likewise with Microsoft, As you'll see that's circled in the red, the entertainment and devices category, this is what Microsoft categorizes their mobile devices under, so just important to think about as we go on. Notice that this category has only grown 1% over the last 5 years. With Microsoft's Windows division by 3.5% over the same period, we would expect a larger portion of this to be compensated for in the entertainment and devices segment if Microsoft were poising themselves to be a very competitive member in the mobile market.
This is a comparison of the market share between Qualcomm and Intel. Since 2009, Intel's market share has decreased while Qualcomm's has increased. And in the past 3 years, so from 2010, it's actually just been a 6% swap of Qualcomm stealing Intel's market share.
And like the slide before this, this is Microsoft's share compared with Qualcomm's in a closed market scenario. And as you can clearly see, Microsoft has also experienced a 6% market share decrease due to its competition with Qualcomm over the last 4 years. Okay, so in conclusion, we find that Intel and Microsoft are still stable companies that exhibit the ability to continually produce attractive dividend yields in the short run. However, we also recognize that Intel and Microsoft have fallen behind current innovations on the market and are not positioned correctly to become formidable forces in the mobile market at this time. For these reasons, we recommend a 3% trim to our Wintel holdings, and this will reduce Wintel in our portfolio to a 7% weight. Excuse me. Excuse me. Thank you. Okay, so this will reduce our Wintel exposure to a 7% weight and also allow us to take a 5% position in a rising IT sector competitor, Qualcomm. Together, the Qualcomm, Intel, and Microsoft investments will overweight the fund's exposure to the IT sector and poise the fund to reap the benefits of stock price corrections that we expect to see in this industry moving forward. Right. Any questions?
How about some questions about that thesis? And then pass it down to Bill.
Thank you. Kevin Encielser, West Star Energy. My question is, I guess for you, Stevie. You made a pretty good case for declining PC sales, and I certainly wouldn't argue with that. My question is a qualitative one. With Intel's new Silvermont mobile processor, how do you believe that's positioning them in the mobile market?
It is helping them. That Silvermont actually came out today. It is helping them, but they're trying to make such a late move into the mobile market that they just don't have that first mover advantage, which is why Qualcomm's already established in the mobile market, and we just prefer to, we don't think that Intel's not going to do well, but Qualcomm's already there, so we just prefer to kind of have Intel move over and let Qualcomm come in.
I'm Bill Greiner, and I'm with Mariner Wealth in Kansas City, and I'm the oldest guy in my firm, but I'm also the most experienced, so I'm not really up to snuff on technology ideas, but as Jim will say, he'll back that up. Why did they expand their debt structure last year? Why did Intel expand their debt structure? And first of all, I agree with your thoughts. I think trimming these two stocks probably makes sense, but particularly going into Qualcomm. But I think also your thesis on the Intel side is holding together with a 2% expected revenue growth rate. And that's in the face of nominal GDP growth probably rising by 4%, roughly speaking, in the U.S., not real GDP, nominal GDP, which should mirror fairly closely corporate revenue growth rates going forward. So Intel, you think, is going to grow top line at half that of the average company, whereas historically they've grown by 7%. That seems to be a pretty brash assumption, and if you can back that up a little bit more for me, I'd appreciate that. And secondly, what did they do with the debt structure? They increased their debt outstanding by a fairly significant amount. Did they go into some kind of a share repurchase program with that money?
I didn't look too far into the debts. For the revenue growth rate of 2%, We have that at 2% really just to be conservative. Realistically, it probably won't be 2%. It might be closer to the 7% that I think you said. But we were just being conservative so that we could show, even if, worst case scenario kind of, if it is 2%, the stock is still undervalued based on our forecasting assumptions.
And if I may add to that with some numbers, in 2011, Intel issued about $5 million in bonds and reduced their equity by $4 million. And then in 2012, they increased their equity again by about $6 million, but then they doubled the long-term debt. So that's part of the expansion in those margins that we see there, is that piggybacked effect of the doubled long-term debt.
Okay, it's Jim Reed with Scout again. Recently, Intel cut a deal with Altera to let them use some of their foundry. Why would you hang on to your Intel position at all if they're having trouble filling up their foundries, making their own chips?
Well, large cap companies like Intel and Microsoft, they'll be in their down phases, but they really aren't allowed to stay in those phases very long until they decide to shake something up. And actually, they have done that. The Silvermont that was just introduced today, and then just last week they announced the new appointed CEO. So they have changed their CEO to shake things up.
Any other questions about that Microsoft Intel space? All right, I'm going to zip on to the other side of the room.
Hi, I'm Heather Gelsinger, third-year student at Washburn Law. DJ talked to us earlier about Volkswagen and their plan to do better. I'm kind of curious, and I think you might have just touched on that, the CEO shakeup and the silver product. Do either companies, have they kind of recognized the fact that they're having some issues, and do they have plans to do something better, or could you talk a little bit more about that, please?
Yeah, they are trying to move into that mobile market. Like I said before, it's late moving into there. For Intel, they have actually teamed up with Google to start trying to put Intel chips in some of Google's phones, so the Android phone. And then with Microsoft, they have the Windows phone. Some people in here might have it. It's been out for a while. Do you have anything else to add about that?
Yes. Let me. Would you recall the question for me again? I had a point, but.
Oh, sure. Does Microsoft plan on doing something better to get their numbers back on track, basically?
Right. Okay. Microsoft definitely needs to make a move into the mobile market, and they're definitely coming at it from behind. One of the things that I mentioned is the cloud computing, that they kind of have a unique opportunity to get into, albeit late, but because of the differentiated approaches, so long as there's of good quality, they can sneak in and experience good success with that. But one thing worth mentioning is that their business systems and their enterprising systems and their servers and tools categories are still some of the leading in the United States. And in fact, these divisions are largely carrying Microsoft forward. Our concern is that if they don't weave everything together, their business enterprises and their servers and tools with a mobile market, and really look forward, that eventually there'll be some stagnation. So we recognize that they have good products that are going on. Like their Windows still sold 400 million copies last year. Their Office still sold 100 million copies last year. And despite them feeling the largest percentage of that 11 to 14% in PC decline, Microsoft has estimated that 8% of that came directly out of their demographic. They've still been able to increase revenue by about 27%. So right now, while they're entering a phase of R&D and repositioning themselves, they are relying heavily on their tools and server divisions and their business enterprises.
Anyone else? All right, it's a long time to sit, so how about a 5-minute leg stretcher, and then we'll see our next two presenters.